Chapter 3, Part 2, and now we're going to finish the whole accounting cycle, and we're going to look at the financial statements and then our closing entries. Now, what we've talked about again so far is during the month, we analyze financial transactions, we journalize, we post, and then we prepare an unadjusted trial balance. We then do adjusting entries. We prepare an adjusted trial balance, which is the only one that can be used to prepare financials. We prepare the financials, and then we do our closing, and then we prepare a post-closing trial balance. Again, this is done after everything else is done. It's the last thing, and we only do this once, and it's the end of each year or fiscal year. So we'll go back to our trial balance, and now what we're going to do now, what I like to do whenever I'm using an adjusted trial balance is I check off things as I use them, because everything that's here you're going to use, but you're only going to use it once. So we'll start with the income statement. First, we'll show our revenue. We'll then list our expenses, show a total, and that gives us net income. This total then goes to the statement of stockholders' equity. Stockholders' equity. We start with our beginning balances, and since it was the beginning of the year, we had no common stock retained earnings, stockholders' equity, and we know during the year we issued stock. We had net income, which we got from the income statement, and that we paid dividends. And these are the balances that are now going to go to the balance sheet. And this is the thing that students often forget. You need these totals. Do not take the totals that are on the adjusted trial balance. You need to take the ending balance from the statement of stockholders' equity. Now, we do a classified balance sheet, which means we have to segregate current assets from long-term assets. Current assets are anything that can be converted to cash or consumed within the next year. Anything that's held longer than that would be long-term, and the same goes for liabilities. So let's take a look at our balance sheet. We would list our current assets based on liquidity. Cash is always first, then accounts receivable and office supplies. Then we do our PP&E, the equipment less the accumulated depreciation. And now we know that our liabilities and equity must equal $128,400. We then list our current liabilities, then our long-term, and then we show our stockholders' equity, and we are the same. We balance, which means we're good. Again, these two must equal, because assets must equal liabilities plus equity. Now we're going to take a look at the closing process. Now, the closing process, only done at the end of the year after financials are prepared. Transferring balances from what we call temporary accounts. Temporary accounts are any accounts that are on the income statement, i.e. revenue and expenses, and dividends. And we're going to transfer their totals to the retained earnings account, because that's a balance sheet account. So we're going to reduce all of our temporary accounts to zero. And we do this at year end, after we prepare the financials. Again, temporary accounts closed, their revenue, expense, and dividends. Permanent accounts are not closed. These are assets, liabilities, and equity. Now, when we do the closing entries, we start with revenue, then we do expenses, and then we do dividends. So, when we look at our general ledger, everything that I've highlighted are all the accounts that must be reduced to zero. They're the dividends, our revenue, and expense accounts. So, first we're going to close our revenue accounts. And since sales we know has a credit balance, we need to debit sales and credit retained earnings. Expenses, we know they have debit balances, so we have to credit them to zero them out, and then we're going to debit retained earnings. And the last thing we're going to do is close out our dividends. Now we can again look at our general ledger. And as you can see, now only accounts with balances are the permanent accounts that appear on the balance sheet. So if you notice, Those are the accounts that appear on they have a zero balance. But I've also added the account retained earnings. That's why I highlighted that for you. Now, post-closing trial balance. Remember, it is only your permanent accounts and always ends with retained earnings. And, of course, your debits must equal your credits. And that ends Part 2 for Chapter 3.